Hi, welcome back to the channel. Now, before I walk through all of the key charts and the data, as well as a high-level broader market analysis, it's been an incredibly choppy last few weeks since our video where I talked about the potential for technology stocks to come under pressure. Now, since then, we've had a little bit of a rotation into the energy markets, but I think the big question everybody has, and many are certainly asking, is if we can buy this dip in the tech space. I will get into those charts, but there are a few things that I want to cover before that. Now, we've had Wall Street perma bear Mike Wilson capitulating. Now, if you don't pay attention to things like contrarian signals, magazine covers, etc., that's really been a signal to get worried from a bullish perspective. We can also add in Michael Burry's $1.6 billion doomsday bearish bet on the US markets. So it's been a wild few weeks. The Michael Burry bet in particular has garnered a lot of attention, a lot of headlines. He's of course the guy behind the movie The Big Short, which is basically a movie of his life. But everybody's wondering if there's something much bigger lurking around the corner. We've had earnings season, it's mostly now in the rear view mirror, but looking ahead to next week, we do have a big report coming out from Nvidia amongst many others, so it does promise to be a little bit more fireworks on the horizon. This week, as well as all of the major indexes, I want to give some clarity to the correction that we're currently seeing. I've got around 15 individual names that you can add to your watch lists for the next few weeks as well. And as always, I hope you find a lot of value from my work, and hopefully the Scottish accent isn't too difficult to understand. Now, most people are really asking where the market might rebound, and I do have some charts prepped this week. On one hand, we've still got the perma bears screaming that it's 1929 and 2007 all over again. But on the other hand, we've got a lot of the perma bulls screaming that we need to buy this dip. Now, for clarity, as everybody knows by now, I'm neither a perma bull or a perma bear. I'm very open to all outcomes. I analyse the data as it comes in, like all good analysts. But managing risk is always priority number one. Now, just a quick glance at investor sentiment. We can see that the fear and greed index is for the first time in a while now showing that there's a bit of fear out there, which you'd expect when the market is correcting. The big danger at the moment is catching the dreaded falling knife. Now, I've been asked a lot about my attention grabbing headline from my weekly letter on the 8th of August, so I'll get into that as well for those of you that maybe follow my work a lot closer than my YouTube channel. So with the analysis this week, I'll do my best as always to filter out all of the noise and present the usual clean charts and data. But for disclosure, myself or my clients may already hold some positions in some of the names mentioned, but I have highlighted disclosures and recommendations on the charts. If you're new to the channel, I like to use a combination of technicals and fundamentals. I'm told that I'm very good at removing a lot of confirmation bias from my charts, and as most of you know by now, I don't use magical hindsight indicators. I timestamp all of my work, which is incredibly important for the field in which I work. I'm not a short-term day trader. I think that's very important to say. I'm not looking for tiny little 20-cent moves. I'm looking for structural trends in the market that will last weeks to months. I work with systematic process, logical targets. My work is really for everyone. Everyday investors, traders, options folks, financial advisors, money managers, but it's not designed for buy and hold investing unless you are using price charts to scale into the names that you like. And I'm told that my charts are among the very best in the business, so hopefully the charts all make sense. Now, before I dive into the charts, there's a few things to maybe give myself a little bit of credibility. Like I said before, my work's all time stamped. I'm not one of those analysts that makes broad market calls before they play out 6, 12, 24 months later. Very few go on the record with their work. I'm one of them. Some of our recent big time-stamped calls, the market crash 1 year ago, every single major turning point in the market last year, including the bear market rally last June, the rally top in August, a massive market bottom call in October, and then a rotation back into technology stocks at the start of this year, and we could go all the way back to the crash of 2020 as well, where we got our clients and subscribers defensive ahead of that as well. I only use my own charts and data. I have a track record of being mostly correct, which obviously helps. So if you find some value from my work, please do like, share and subscribe on YouTube, and feel free to subscribe, share, retweet on Twitter, etc. as well. Please do pause the video, make sure you're comfortable with that very important disclaimer before we kick on. And if you are somebody that needs technical analysis software, we have recently partnered with TradingView. They provide a very generous 30-day free trial. They're absolutely perfect for everyday investors using technical analysis, as well as being incredibly cost and effective. I only partner with the best companies, and TradingView are one of them. But to be clear, this is not for access to our client work. TradingView is purely for technical analysis software, and there's a link in the description for a free 30-day trial. So enough rambling on, let's dive into the charts. Let's start off with the US dollar. I think I have talked about the US dollar index and the inverse correlation with the S&P 500 to death over the last couple of years. If you don't know by now, the message the charts tell us is when the US dollar is going up, the S&P is going down, and vice versa. Now, the big question everybody has at the moment, and I did highlight this in our last video 3 weeks ago, just highlighting the danger of a rising dollar, and that's exactly what we've got. So the big question is, how much further can the US dollar move? Well, it really depends. After putting in a failed breakdown a few weeks ago, with range bound charts, there's nothing fancy about the chart. It's really just it moves from the bottom to the top a lot of the time. If we do break out above this 103.75, 104 level, that brings another couple of percent upside. And I think if the US dollar index is going to reach those upside levels, then I think it's quite reasonable to expect the US equities market to come under pressure a little bit. That's not to say that all stocks, by the way, go down in that environment. There are plenty of stocks that are holding up well. I have plenty of them that I'm going to be covering in around 5 minutes. But one of the charts that I'm also focused on at the moment as well is the 10-year Treasury note yield. Again, I think general consensus with TNX is if the 10-year note is going to break out of this base and move higher, that's in an environment where a lot of the growthier, riskier assets in the market, the growth tech names, for example, are likely to come under pressure. So what the 10-year note does at these levels will give us some clues as to what comes next for a lot of the technology names. The obvious inverse to that is the bond market, and TLT is a chart that I'm working with and watching very, very closely at the moment. Now, for those that follow me on Twitter, you'll know that I put out a little bit of a clickbait chart during the week, just highlighting that there's a potential 13.5% downside in TLT. Now, if we get a 13.5% decline in TLT, the 10-year note is of course going to be breaking out in that environment. But there is the possibility that if TLT is going to rebound from the lows last October, which, as we all know, what happened in October last year, we had stocks bottoming in October last year. So I am watching this chart with a lot of interest at the moment for a potential rebound. If we can get a rebound in TLT, potentially that could signal some kind of move higher for stocks. But to the other side of things, we've had a correction in XLK. Again, for those of you that do follow my work a lot closer, and not just on the YouTube channel, where I am only able to post YouTube videos, once a month usually. But the XLK chart failed breakout. We've obviously communicated this a few weeks ago to our clients, but we have corrected 10% already. So the big question everybody has is this as bad as it's going to get for XLK? I am open to the idea and the possibility that tech could catch a bid over the coming weeks. I think you obviously have to look at all dips in the market as an opportunity to buy. I don't see a scenario where we're looking at 2008 all over again, or 1929. But what we can see again with the equally weighted tech space, again, we've had a significant decline after meeting resistance at logical levels. And again, we're pulling back to levels where I think it's quite reasonable to expect some kind of rebound. But again, all bets are off. If we start to break down below these levels, tech is going to continue to come under pressure. The triple Q chart, again, what some of you might be a little bit, what's the word I'm looking for here? What some of you might not know is that the triple Q chart is really made up of only 55% of technology and 45% of everything else. I think there's a lot of you folks that I'm sure use the triple Q chart for a gauge of tech, and I do understand it. But something that I am very mindful of is when the market undergoes these challenges and these corrective phases in the market, oftentimes we can get the suckers rally. And what the suckers rally is it's really just a move higher for a couple of days. It looks quite convincing as a market bottom, and then the rug gets pulled from underneath, and then the downtrend continues. So that's why corrective phases are always very, very difficult. The danger is always catching the dreaded falling knife. So I am very, very mindful of charts like this where there is some significant potential downside to aim for. We've got the NYSE composite, again, big chart if you want to have a bigger look at the market and not just a basket of 500 stocks like the S&P 500. Potentially putting in a failed move again above this pivotal 16,000 level. We've got the Dow. Again, it looks a little bit toppy there. It is holding up intraday at the moment. There are still 3 hours left in Friday's session, which at the moment it's currently very, very volatile. It's been down a lot. It's starting to flirt with being positive on the day. This is all just the noise of the market, and what you're really looking for when the market is moving back and forth and we've got a little bit of volatility is you just want to see these key support levels hold up on a technical level. The same with the All Country World Index. The rally recently hasn't just been US stocks, it's been all across the world. But again, I want to see these levels in charts like the All Country World Index continue to hold up. The S&P 500 ETF SPY now, whether or not you believe in Fibonacci levels and the voodoo and all that nonsense, in the technical world, I think most of us understand that Fibonacci levels are, for whatever reason, they just work. But I've applied a Fibonacci retracement tool to this chart. The S&P is down around 5%, so we can view it as a healthy pullback in the S&P 500. It's not a correction that we've seen in the likes of XLK. It's purely a clean, healthy pullback at the moment for the S&P 500. But again, if you are in the camp that you want to buy this dip, you probably want to see these levels hold up as support and then get some kind of rally into the close today, followed by a follow through day on Monday. That's certainly what I'll be looking for and something that I'll be communicating to our clients and subscribers this weekend. We've had big declines in the equally weighted S&P 500, down around 7%. Again, is that as bad as it's going to get for the market? Again, I am very, very mindful though of these suckers rallies, which just entices everybody to jump in, and then the rug gets pulled. That's the danger at the moment. The mid caps stalled at logical levels. We've got the Russell 2000 again stalling at logical levels, but is a 7% decline going to get bought up? Again, we'll need to see what the market throws at us over the coming weeks. But just to highlight why I have a big problem with failed breakouts in the major indexes, is we just need to have a look at history and recently. And since I've moved into the professional game, which is going I think 7 or 8 years now, over the last 5 years we've had 3 massive crashes, and characteristic and what's helped me get our clients and subscribers defensive ahead of them a lot of the time is the humble failed breakout. It's a really good early warning signal, and do with that information what you will. I think it's information that's often overlooked. A lot of folks don't realise that you just need to have a look for failed breakouts in major averages, amongst many other things, of course, things like the US dollar, 10-year note. It's a massive interconnected market. There's not one magical indicator, unfortunately. But something I did want to touch on is the rotations that we've seen in the market. Now, if you are not sure what this chart is, this is what's called a relative rotation graph, and the relative rotation graph here is benchmarked against the S&P 500, which is the center point. And we have 4 quadrants. We have the weakening quadrant, we have the lagging quadrant, we have the improving quadrant, and we have the leading quadrant. And the theory behind the rotation graph is, as I'm sure you can guess, we have sectors that just go round in circles. Now, it's very, very clear to me at the moment is the tech space, which I've just used the triple Qs and XLK, have been leading. They're moving into weakening, and the theory is that they move to lagging. But what I'm interested in is what's going to be the next leaders in the market. And as we can see, XLE, XOP, just a couple of energy ETFs look to be heading towards leading. So a lot of my work over the last few weeks has actually been focused on the energy space. We just need to have a look at the oil markets, and we are patiently waiting for a potential breakout here above $88 and $85 here for both Brent and crude. I think if the oil markets can get going, if we can see gold potentially catch a bid, I think there's 50% upside if gold can get above 2100. And if we see the rotation into the oil markets, then the hope is, again, we can get some kind of catalyst across the whole commodity space. I do like to use the Bloomberg Commodity Index as my gauge of commodities as a whole. So if we can get above 110 there, then I think it's probably risk on in commodities. And certainly I am working on the theme of rotation at the moment. Now, before I get into I think there's around 15 individual names, it probably tells me that you're getting a lot of value from my work if you're still here. So please do hit the like button. It helps to get my work noticed and all the algorithms, etc. on YouTube. And it would be much appreciated. So, semiconductors. Now, we have NVIDIA, as I said a few minutes ago, reporting earnings this week. Now, semiconductors have really stopped going up. Across, just broadly speaking, you could look at, Nvidia, AMD, etc. They've all pulled back over the last few weeks at very logical levels. Now, I've been watching the SMH chart, like I'm sure many of you have, looking for a breakout, and then that could potentially spur further upside in a lot of the semiconductors, but we've not seen that as of yet. We are seeing semiconductors with the rest of technology stall a little bit. So after the runs that we've had in names like Nvidia, now for disclosure, I sold my Nvidia position last month at around $400. It moved up to around 480, 475, and pretty much met our upside targets for our clients, members, etc. It has pulled back, but what I would say with Nvidia is I'm watching it very, very closely for a healthier pullback with earnings. I've no idea what the earnings reaction will be. Nobody does. But I think if we do get a pullback in Nvidia, etc., then I will be looking at it as an opportunity to get back in at lower prices. But just to dispel the myth that all stocks are going down at the moment, it's not the case. I do have quite a few charts here from our chart book that I've been covering for the last few weeks. I think TJX is a really good example of slow and steady wins the race in the current environment. It has this week taken out its next pivot level at 87.75 and looks to be potentially breaking out again. Our systematic process now has the stop loss up at 85. So things are moving pretty well, I think, if you are an investor in TJX. Again, ConocoPhillips has been one of our energy plays. Big healthy pullback around 10 days ago, but big rebounds, and next pivot level would be potential breakout above $118. Cameco, just for disclosure, this is one of our high conviction charts that's been going a few weeks now. Potentially looking to take out another pivot level there around 35.24. So I think if there's a further breakout here in CCJ, I think there's logical upside targets there at 44. But we, like I said before, we do work with systematic process. That my work is really focused on it. So if there is a breakout, I would like to see the stop start to advance as well. We've got CBOE again making new all-time highs over the last few weeks. It's really been working very, very well. Moderna. Now, Moderna is an interesting one. I think what I would say about stocks like Moderna, Pfizer, etc. I hate them. I don't like the whole COVID thing and the vaccinations, etc. If Moderna went to zero, and I wouldn't care less, but it doesn't mean that you can't make money from the chart and from the stock. Last week we put out a chart just saying it was reasonable to expect some kind of rebound in the chart. Now ultimately we've had that over the last couple of days. I think it was up around 7% yesterday, but really I think to be really appealing to me personally, I think it would need to be above that 120 level, 115 level. So that's a typo. Let me just quickly correct that. So that's a chart that's certainly on my radar, just in case the market does decide to rebound a little bit. I am looking at charts like Tesla as well, very similar to Nvidia. Tesla has been unbelievable on two separate occasions this year, but we have pulled back to a logical support level here for Tesla. But really, if I'm being completely honest with everybody, I would much rather see some kind of capitulation event like we had at the start of the year. just purely from a selfish perspective, that I don't have a position in Tesla at the moment. I'd like to have a position. We did get capitulation back in January. We made a big bullish call at the time. It worked incredibly well, but we'll see what happens here at this 220 level. I think if there's a breakdown below this 220 level, and there's a convincing move below it, then I think the path of least resistance will, in the short term, be lower. But I would hope that everybody is looking at Tesla as a buying opportunity. Exactly the same with Apple. I'm looking at potential support levels here for Apple. I did post this chart to Twitter earlier on this morning, just highlighting the Fibonacci levels that I'm looking for some kind of rebound. But this isn't really anything that's getting me excited at the moment. It's currently up around 0.25% at the moment, but for me the chart is still showing a bit of weakness. We've got MasterCard continuing to show a lot of resiliency. Potentially, if that can get a breakout in a market that is going to rebound, then potentially MasterCard above $400. Amazon's another one of those that I'm actively looking at, dips, potential support levels, etc. Now, we actually recommended this to our clients on the 10th of April and it met our upside targets. It has pulled back, so we'll see if it dips below these levels and completely craters, or whether or not the market and the buyers step in at logical levels. It's not any surprise or any fluke that the market responds to our trailing stop levels, so I'm looking for potential support to kick in here as well. Now, a few other names that I think warrant some consideration for the next few weeks. I think Mosaic Company, it's had a down week this week, but it does look like it plays into the whole rotation theme. So I think if Mosaic can get above that $43 level, YPF is one of our buy low sell high charts. It's massively outperforming the S&P 500 this year, outperforming it to the tune of 40%. So again, buy low sell high charts. I don't shy away from range bound charts. I like them very, very much. We've got H&R Block. I think this $40 level, just for disclosure, but this $40 level is a big level, I think, for this stock. And if there's moves above it, then again, the hope is that it can keep moving higher. Big breakout over the last couple of weeks in Consol Energy. We've already had earnings announced. Low PE ratios, massive 12 months earnings growth. We've got CLS, again, absolute monster over the last month. Ultimately, just waiting to see how far it ultimately wants to go. And we also have Home Depot. We've had earnings now out the way. Things are moving really, really well. Looks like it's basing relative performance, outperformance to the S&P 500. But the next breakout level there for us is around 342. It did ultimately get very, very close to our upside targets. It has pulled back, but again, pullbacks and uptrends oftentimes offer opportunity, but it's going to be very, very much dependent on what comes next with the broader market as to whether or not this trend ultimately continues. The market really is, incredibly choppy at the moment. It's incredibly challenging. I think, with my track record of getting the big turning points in the market, I think that there's a big focus, certainly from our client base, that there's an expectation that I'm able to get folks back into the market at the right time aggressively. So apologies that I'm not able to upload videos to YouTube every single week. It's an incredibly, incredibly time consuming endeavor. This video, for example, all in probably takes about 10 hours to prepare, present, edit, upload, etc, etc. So I would appreciate it very much if you hit the like button. If you have just recently come across my work and you're wondering who I am, what it is I do, feel free to jump on to our website at honeystocks.com. There's a link in the description. But we provide subscriptions, memberships to all of our premium work, access to all of our premium weekend analysis, all of our high conviction investment ideas, which I'll show you what that looks like in just a second, access to our midweek halftime report, access to a wonderful community of investors, traders from all over the world, access to all of our chart books, our weekend hot list, which covers stocks, sectors and commodities. If you are somebody that's in the process of maybe learning a bit more about building your own system for your own personality and process, etc., I'm told that I've built out a really good technical analysis program which will help you do just that. But just to quickly show you what our high conviction ideas look like, I think I touched on Tesla just a few moments ago about capitulation. That's really what we're looking for. Tesla's been amazing on two separate occasions for us this year. Meta, which has been an absolute monster again. DraftKings, which did very, very well. JP Morgan again has done pretty well. Amazon, monster. Home Depot, which I just covered a second ago, has done very, very well also, as well as Apple, which hit our upside targets and then some. But I am very, very unique in what I do. I do log and timestamp all of our work, and that includes our high conviction ideas. You can jump onto our website and check to see the types of stocks that we like to recommend, how those stocks have then gone on to perform. And the reason for that is just so that you can see and you can marry it up with your own process and your own philosophy to investing and trading. But I've done this every year for the last 5-6 years now. So feel free to go and scrutinise that and do all your own due diligence. But I think generally speaking, my work is good for anyone that has a mid-term approach, weeks to months. Maybe you've just had enough with day trading. You've found out the hard way that it's too stressful. Maybe you're looking to learn a bit more about technical analysis and systematic process. Maybe you're too busy with work, life, family, etc. to find the best stocks. Or maybe you just want to be part of a community and you're sick of hunting around YouTube and Twitter for ideas. But again, like I said, check out our website, see if anything's a good fit, and if it is, I'd love to welcome you. But if you've stuck here to the bitter end, from the bottom of my heart, thank you very much for watching, and be well out there. It's not easy. Thanks as always.